time has flown past us, and the environment has shifted markedly since the last time we gathered in April. While the pandemic has faded into the background now, its aftershocks linger on. At the time of the April Monetary Policy Forum, we indicated that we were walking a tightrope as inflationary pressures persisted globally and here at home, while growth appeared fragile. Uncertainty remained exceedingly high at the time. In this addition, there are signs that the storm is clearing. The rate of price increases has softened almost everywhere. Encouragingly, this improvement has not come at the expense of output growth. Here at home, a lot has happened over the past 6 months. Load shedding has been suspended since late March. This, along with the unwinding of election-related risks, saw most sentiment indicators become more upbeat. Also, inflation fell to around the midpoint in August, and the South African Reserve Bank eased monetary policy slightly in September. Nevertheless, structural challenges remain. At the September Monetary Policy Committee, we remain committed to achieving our mandate of price stability in these challenging times. We seek to keep inflation firmly anchored closer to the midpoint of our target band. As I have often remarked, an anti-inflation central bank is a central bank that is pro-poor. Moreover, low and stable inflation will support a balanced and sustainable growth of the domestic economy as the storms of the recent years continue to pass.
Well, global inflation is certainly easing, but that convergence to lower inflation rates is slow, and we've seen quite a few reversals. I'll show you a little bit about what those look like. All of this will allow rates to fall. We've seen policy rates cut in a variety of jurisdictions, but there are some questions that linger out there about how fast and how far interest rates will continue to fall. Global growth is historically at a modest level, so not a good thing, but it is resilient, and it is underpinning, in that way, inflation. On the domestic side, growth is still weak, but it's gradually lifting. I'll talk a bit about that. Fuel, food, and foreign exchange-related prices, imported goods prices in particular, continue to pull headline inflation lower, and over the past few months, that dynamic, that trajectory has happened at a faster pace, which is good. What we want to see, of course, is spillovers from those exogenous prices to core and to inflation expectations, and we see some of that happening. I'll show you what that looks like, and that will help with inflation stabilization going forward. Policy is still moderately restrictive, but something closer to neutral seems to be on the horizon. Again, that's the good news. So where is global inflation currently? Well, it continues to ease, as I said. The left-hand chart shows you the global inflation outlook from the IMF for the previous years, and 2024, it's looking like it will come out at around 6%, slightly higher, and then ease further to somewhere around 4.85% in 2025. That's the forecast. On the right-hand side, I'm showing you the historical trajectory for inflation. And what's interesting here, I think, is that you can see extremely low inflation running up from 2016 all the way through to 2021. Obviously, inflation collapsed during the pandemic, and then we saw this very sharp increase through the post-pandemic trajectory, and then we saw this disinflation process start. Sorry, let's see if my laser pointer works here. Yes, here we go. So the question is, What's happening now? And this is where there have been some setbacks. We got to a lower inflation rate, and then suddenly inflation bumped up again for a variety of reasons. In different jurisdictions, inflation has been more volatile than has been expected, and we'll get to some of those countries just now. But overall, there's a disinflation process that's happened. It's stabilized over the latter part of 2023 and into 2024 with some reversals. And then we get to see this disinflation happening again. And of course, we would like to see that continue. So much of the disinflation process has been pushed along by goods prices disinflating around the world. This chart shows you the emerging markets goods price inflation in blue and the advanced economy goods price inflation in red. And you can see for advanced economies, we're down to somewhere around 0, and emerging markets, we're still sitting at around 4%. So very strong disinflation, but seems to have stabilized at those levels. There is quite a lot of drag continuing from services prices and what appear to be still firm labor markets, particularly in advanced economies. Let me start with the advanced economies labor markets. That's on the right-hand chart. You can see this is a measure of job vacancies per unemployed person, and you can see that those vacancy rates have remained really quite high through the whole of the post-pandemic trajectory, and that means that these labor markets are demanding workers, and that has underpinned wage growth in these economies. Another version of wage growth or core inflation comes from services price inflation, and that's on the left-hand chart. And again, you can see that in advanced economies, it ramped up, that's the red. It also ramped up in emerging markets, but it's come down more strongly in emerging markets, and it's stabilized quite a lot in the last sort of 8 months or so in 2024. And again, there have been some small setbacks there. You can see that emerging markets have seen a pickup in services price inflation back up to 4.5%. So that's going in the wrong direction. Services and wages are contributing to keeping core inflation across many countries above target. This chart just shows you across a range of different countries. Advanced economies are on the left and emerging market economies on the right. And so services and wages are helping to keep core considerably above the inflation targets that those countries have. Some of them are quite extreme. In the UK, core inflation is about 2 percentage points above its target. South Africa, Chile, India are doing much better. We've got core inflation much closer to the long-run rate that we want it to be, and it's, for South Africa in particular, it's come out slightly lower, which is good. Nevertheless, despite core inflation keeping a bit higher than expected, there's more confidence out there that the disinflation process will continue. You can see on the left-hand side the translation of all these numbers into headline inflation rates. Again, advanced economies have come down more sharply than emerging markets, but emerging markets continue to see headline inflation easing over this time frame. And if we look at a measure like inflation momentum, so this is the percentage change in headline inflation over a 6-month period, you can see that these momentum measures are very low indeed, in particular for advanced economies. So this is giving some support to greater confidence and more optimism that inflation will continue to fall. And this has allowed a starting of the easing of policy cycles around the world. Again, I'm divided up here. The left-hand chart is advanced economies, and the right-hand chart is emerging market policy rates. Again, what you can see is the solid line are the actual movements in policy rates, and then the dotted lines are what the markets expect the policy rates to be like in the next year, and that's true for both the emerging markets and the advanced economies. The takeaway from here, I think, is while there's good news, there's also quite a lot of caution. So, as you all know, central bankers, and you criticize us quite a lot for this, we're always very cautious. But what this tells you is that the markets are also very cautious. So there's something going on out there in the data and in the trajectories of economies that has got the markets a little bit worried about the long-run trajectory for inflation and the long-run trajectory for policy rates. You can also notice that even when we get to the end of 2025, the policy rates for both emerging markets and advanced economies are well above the pre-pandemic policy rates. So another signal that there's quite a lot of uncertainty about how much further this is going to go. This chart, this set of charts also says the same kind of thing. Let me clarify some confusion for you right up front. These solid lines here, we had a glitch. These are the long-run policy rates for the advanced economy groups. We couldn't get them to remain dotted, so they're now solid. So there you go. The punchline here, though, is that I said the markets are worried. Well, they're worried for a few reasons, and you can see on the right-hand side that at the end of 2025, for emerging markets, the markets are not saying that policy rates are going to be very, very low. In fact, what they're saying that is across all of these countries, policy rates are going to be lower than they are currently for South Africa, around 7%. That's the black line. But for some of these countries, the markets are now expecting policy rates to start rising again. And that's not the direction they want to go, and it says something about their underlying inflation trajectories that, again, have the markets worried. On the advanced economies side, that's the left-hand chart, different story. You know that in the United States, the blue line here, inflation has come out lower, quite a lot lower in recent months, and that's allowed the Fed to start cutting, and the market is expecting further cuts going forward through to 2025. The Eurozone is in a somewhat similar situation, more stability in their rate, but then a few cuts at the end of 2025 as disinflation starts to catch hold there. But the UK is an outlier, and the UK is really not very clear where things are going to go. There were expected a range of cuts earlier in the year, and now by the end of 2025, it looks like rates may actually creep up a little bit, but we'll have to see. So let me turn to global growth. As I started in the beginning, global growth is resilient but remains modest. Those little black dotted lines are the long-term 2010 to 2019 average real GDP growth rates. At the world level, that's the left-hand block of this chart, that's sat at just under 4%. For advanced economies, that's sat at just over 2%. And for emerging market economies, that's sat at about 5%. And so the blue trajectory is the post-pandemic decline in inflation, in GDP growth, the moderation GDP growth. And then the stable blue line is where growth is now, and the dotted blue lines are the forecasts. And so no one is expecting a very strong pickup in global growth, either in advanced economies or in emerging markets. So we face a difficult future when it comes to growth. Growth has been carried along by services, primarily, particularly over the last 2 years, while manufacturing has remained quite subdued. So manufacturing in this chart is the blue line. This is the Purchasing Managers Index. This is not actual growth rates. And red is the services. So we saw during the pandemic a shift in the composition of growth towards goods. Manufacturing picked up very strongly. Services did pretty well too. You can see that on the left-hand side here. Both the blue and the red picked up very well during the post-pandemic period. And then we've had this lull, and now we're trying to find our feet going forward. So what's going to drive growth at this stage? It still seems to be services. So let me turn now to South Africa. Growth continues to lag, unfortunately, quite far behind our peers. I'm just showing you here, the red is South Africa, and the emerging market and developing economy averages is the blue. We fell into a bit of a slump really in about 2013, 2014, with much lower growth rates than we had previously. Then, of course, we had the pandemic collapse. We had the bounce back from the pandemic, and then we seem to be moving back down to, unfortunately, low growth rates. So we've talked about this many times and the range of shocks that have hit the growth rate, so we don't need to go into that now. Just again, at a high level, how do we compare to other countries? Well, we sit in a basket really with countries like Mexico and Brazil. We're nowhere near China, India's growth rates. Both their potential GDP growth rates are much, much higher, as well as their productivity growth rates. And you can see that again reflected in the investment performance of this particular basket of countries, where you've got Brazil, Mexico, and South Africa sitting with investment growth rates, total investment growth rates that are, as a percentage of GDP, which are much lower than they should be, and much lower than more robustly growing economies. Now, we've seen some more positive news coming through the economy, load shedding clearly being the most positive of them all. One of the challenges, though, and some relief of constraints in the logistics sector, but one of the challenges we've seen in recent data, particularly over this past year, is that some of these easing constraints don't seem to be feeding through into our high-frequency growth data very strongly. This is showing you quarterly data. So the blue bars here are the Q1 2024 outcome. The red is Q2 2024, and green is Q3 2024 across the various sectors of the economy. And I would note that the 100 mark is the 2019 index level. So in the only major sector in this economy that has gotten back to the 2019 level in a very convincing way is the retail sector. All other sectors still remain well below pre-pandemic levels, even though our growth rates are a bit higher now. So what have we done for our forecast? So this is the challenge. We see this low growth. We see the reforms happening. We see some better news. How do we pencil this into our forecast going forward? This is one of the channels through which we do that. We look at total investment. And so we try to build in data such as on the right, which shows you the private sector pipeline for embedded generation projects, both those that are in the planning phase and those that are in the connection phase. And the green bar, the green column or bar there shows you the April 2023 data, and the blue shows you a year later, April 2024. And so this is the kind of data that we're looking at to try to re-estimate what we think is happening in the forecast space. This is some of the data that feeds into a revision in our total investment forecast, which is the left-hand chart. And you can see here that, again, we had this really strong post-pandemic bounce back, and then we had this very poor performance in 2024, and what we're penciling in for investment going forward is the shaded bit in 2025 and 2026, as I said, in part on the back of some improved numbers here and other things. Labor market outcomes continue to appear mixed. The data, of course, is sending us mixed signals as it has for quite a long time. Here I'm just showing you the quarterly labor force survey data, which is the green, versus the QES, which is the survey of firms data, which is in black. And they're showing, of course, a very different picture out there. There may be some lingering survey problems in how this data gets collected. But one takeaway from this is simply that the black, which shows you the formal sector, just is struggling to recover, whereas the green, which includes agriculture and the informal sector, has bounced back from the pandemic shock in a better way. Nonetheless, despite this kind of mixed labor market view, household consumption still is doing the heavy lifting in our forecast. This is a bit hard to read this chart, but the takeaway here is just simply that household consumption, which is these blue parts of these columns, is what's driving growth going forward. We've talked many times about the weakness of the terms of trade and how that's sliding. And so in our forecast, we continue to expect household consumption to be carrying most of the burden of growth. The terms of trade is generally lower. I'm showing you that on the left-hand graph, but it's better than it was in March. So while the terms of trade is contributing to our weak growth outcomes, over the period of the monetary policy review, we actually saw slightly better prices for commodities. That's in the middle chart. So that's the blue line is the September forecast, which is slightly above that March forecast, which is the red. And then we've seen oil moving around quite a bit, both by volume and by value, and that's helped buoy on the margin the terms of trade a little bit better than we had expected it to be. So to wrap up on the growth dynamics that we're seeing are certainly not robust, but they are resulting in some upward revisions to our real and our potential growth rates. On the left-hand graph, I'm showing you the real GDP forecast in March, which is the red dotted line, compared to the September forecast, which is the blue dotted line. So as we've gone through iterations of our forecast, we've had a bit more data and a bit more confidence that we can continue moving these things up a bit higher. The easing inflation outlook is also sending us some other good news, which is that it's helped to compress the yield curve and lower the risk premium. Some of you will know, if you watch the South African bond markets very carefully, that that yield curve, which is the left-hand chart, has fallen by, let's call it a rough 200 basis points over the past few months on the back of good news. When we tried to unpack what the drivers of that compression in the yield curve has been, this is our calculations on the right-hand side. What we're seeing primarily are three things, really. This is the risk-free rate, so this is the global policy rate coming down slightly. We've seen an improvement in sovereign risk, so a little bit better fiscal numbers, but we've seen also a very sharp revision down in inflation risk, and that's, in this calculation anyway, driving the preponderance of the move there. This has helped to buoy the rand. The rand, of course, has done quite well on a comparative basis against lots of other emerging markets. We're one of the few that have appreciated sustainably over the period. Now let me get to inflation in the last handful of slides. The stronger currency, of course, is, as I noted right in the beginning, is adding impetus to the disinflation process. This is just showing you the overall headline rate. This chart, I break down the different components of inflation that are moving a lot. So on the right-hand side, you've got food and non-alcoholic beverage inflation. In the middle, you have fuel inflation. And on the left-hand side, you have overall goods inflation, of which some part is imported goods. And all three of these have contributed to a very strong disinflationary process, and one that's was stronger than we would have expected 6 months ago. Those are being matched by a fair bit of control, I would say. I wouldn't quite call it easing yet, but maybe we could call it easing, on unit labor costs, which remain quite muted, and inflation expectations, and then feeding through into services price inflation, which at least is a little bit more stable than we had expected it to be. So if you look at that left-hand graph, you can see again, services price inflation's really kind of quite volatile actually, and jumped up earlier in the year, and now it's starting to ease again. And we are hoping, of course, that these exogenous prices that are disinflating so strongly, alongside muted unit labor costs, which is that middle graph, you can see that these things are sitting right at around 4 to 4.5%. And the easing of inflation expectations, so what will future inflation look like, will contribute to core inflation also stabilizing a bit more and reinforcing that disinflation coming from exogenous prices. This is confirmed by our our more recent set of measures of underlying inflation, which I'm showing you on the left. We introduced these measures in the previous NPR. So I don't think we need to go through these in great depth, but what they all confirm is that there are spillovers into underlying inflation, and that underlying inflation is remaining quite weak and in fact moderating. And you can see that in the core inflation forecast, where these things are feeding into on the right-hand side. So core inflation, for much of the forecast period, really over the last couple of years, we saw core inflation kind of sitting just above 4.5%, and now in the inflation forecast, we see it ticking down below that number and contributing to somewhat better outcomes. So how does these forecasts and analysis compare to some scenarios? In the last MPC meeting, we discussed an upside inflation scenario driven by higher electricity tariffs, faster wage growth, and much stronger rental inflation. And that's depicted here by that blue upside surprise view of inflation, where you see inflation jumping up above that midpoint quite strongly. And then we compared the baseline and that upside surprise, the baseline's the red line, dotted line, to a continuation of a RAND tightening scenario. And you can see that if you have enough RAND tightening, you can get to quite low inflation rates indeed. You can see this green line starts to converge, sits just below 4%, and then starts to ease even further down to something like 3%. So this is one of the ways in which we sense check the baseline inflation forecast that we are looking at. The MPC assessed risks over much of the last couple of years to be to the high side. The graph on the left just shows you for each meeting whether the risk assessment was to the upside or to the downside. And then I circled with the dotted line these kinds of periods where you had a lot of upside risk. And on the right, it coincides with this sharp rise in the headline inflation rate, so that's that blue line. We had a bit of disinflation that came through, and then you had quite a bit of stability again in the inflation rate, and that was consistent with a sense that risks were more evenly balanced, but often to the upside, at least marginally. The last meeting, the committee decided that the risks had now fallen again, and again, that's consistent with this decline in inflation that we see here, and that allowed the committee to choose to cut rates, which you will see up there, that little cut there. So that's the first cut of the cycle. The rate level is important in our view because it's helped to align demand and supply, helping to dampen price pressures, to keep GDP and gross domestic expenditure, which I'm showing you on the left-hand side, in reasonably good balance, and an output gap that is neither contributing to sharp disinflation nor contributing to aggressive inflation. So punchline here, non-core deceleration has been very important. That's the red line, and it's worked with that core inflation outcome, which is the blue, to generate, the black, no, it is the blue, sorry. So the blue line's coming down here a little bit as well, and that's generating this low point in the headline inflation trajectory over the next couple of quarters before it starts to revert back up. And this is a little bit better, clearer picture of what I was just talking about with the latest forecast. So this is the September forecast is blue relative to the March. You get this quite neat drop in inflation in the very short term. So that's the story. Let me conclude with a few points. So global easing cycle is in play, but there seems to be quite a large role for domestic circumstances. We can unpack many of the countries that I did a very summary overview for. Each of them will have different drivers of inflation in their baskets. Those domestic circumstances are definitely very important, and they complicate this easing cycle story. So not everybody is going to ease at the same pace and at the same time and by the same amount. Policy space still remains quite unclear. GDP is resilient and financing needs remain high across many economies, and that will limit how far policy rates can fall. There are certainly fewer negative shocks to the domestic outlook. There is smoother sailing ahead in our view, and that's good news. And core inflation is playing an important role in complementing the decline in exogenous price pressures. They seem to be quite contained up to now, and the yield curve is helping in that effort. Both of those are moving in response to the policy effort that we have on the table. The policy challenge going forward will be to stabilize inflation and expectations at the target, and to avoid, of course, policy missteps that could cause or contribute to inflation reversals.